Forex Nation, what's up guys? Welcome back to the channel. Welcome back to another video as we continue the Blueprint Summit videos. In this particular session, let's go ahead and take care of the TDI, or the Traders Dynamic Index. We're going to break this whole thing down so you can better understand how I use it and how you can use it to improve your trading and also use it for confirmations. So without further ado, let's go.
All right, so let's talk about Traders Dynamic Index, or TDI. TDI is just a tool that I use to help confirm. Right, that's literally what I use it for. There's, I don't know, man, so many different ways you can use it. But again, I'm just going to show you the way that I use it specifically. I don't try to reinvent the wheel or anything like that. I just use for how it works for me. And how it's helped me confirm things. So let's talk about it. So for me, it helps to confirm trade setups. I'll show you this all this in the charts. I use it to help confirm divergence. Divergence is huge. It's a form of confirmation that your directional bias or your trade that you're thinking is good to happen if you have divergence. So I use it for type 1, type 2 setups that will have the TDI at the bottom of the range. So in type 1, type 2 setups, typically all of the lines and stuff are towards the top or towards the bottom. I'm going to show you this in the charts. Type 3 setups bounce off the 50 line off the TDI if they're the good ones. This is literally what I use it for. That's it. Nothing else. There are strategies that you can try to build around the TDI and stuff, and that's all great and everything. Notice type 1 setup, right? This is a type 1 setup here. Where's the TDI here? And what I'm looking at really primarily is these blue lines here are Bollinger Bands, basically. Okay, this basically represents kind of the behavior of the market in the sense of, like, think of these Bollinger Bands like outside EMAs on price action. So imagine like if there was like this. Price action, or the candles, are in the center or in the middle of those bands, right? The price action itself on the TDI is represented by the green line. So this green line that you see on the TDI is literally the candles price action. The red line here is used to confirm an entry trigger, kind of like you would have a close above the 5 or the 13 EMA. So anytime that the green line crosses over the red at the right time, you would have an entry trigger or a confirmation, right? So this would represent this this crossover basically of the green line going over the red line like this is the same kind of representation of what a 5 and 13 crossover would be on the price chart. And the yellow line, this yellow line here, is basically the market sentiment, the overall market sentiment. So think of this yellow line here as what the majority of traders are thinking in their mind, in the sense of, like, if the yellow line is below the 50, meaning the 50 median line here, the market sentiment for retail traders is most likely to be on a selling bias. Okay. Whereas once the line goes over the 50, like the middle line here, then the bias turns more towards to be a selling. Okay. The only thing that I care about is whether or not, when I'm looking at a pattern, can the TDI help me confirm the pattern? So on this pattern here, on this type 1W here, we have price action, or in this case, the green line of the TDI below these two lines here, right? So you see these two dotted lines here. This is where you want the lines or the price action to be when you're looking for a type 1 or a type 2 setup. So you want this to be somewhere here. Just like if you were looking for a sell, you'd want price action to be up here. Okay, that's one thing. Second thing is, I want you to notice how this right here would be the first leg. It comes up and then comes down for the second leg. Do you see how the second leg goes deeper than the first? Does everybody see that? Okay. Now, I want you to pay attention to that, because the second leg goes deeper than the first. Now look at the TDI, and the first leg here on the TDI here is right here. The second leg is up here. Do you see on the TDI how the second leg is actually higher than the first? So when you have that happen and you have the opposite happen, that's divergence. So when you have one thing here happen on the price action chart and then the complete opposite happening on the TDI, that's the divergence that you're looking for. That's a really good thing, because the TDI is already picking up the fact that this should be going higher. So I think when you look at it now, you're like, yeah, the second leg is down here. But when you go back in time and you're looking at this play out, to me, as this is playing out, this right here would essentially be my first leg. If I'm looking at this as it's playing, this right here, I would probably consider the second leg here. That right there would be my entry, because I get a pullback. So you got to remember that when you're looking at this, you have to think about the fact that what would it look like if you were actually, looking at it in real time? Because it looks, makes sense, obviously, when you're looking at it like this, you're like, okay, well, yeah, that's a type 1. But when you're actually in the middle of it, right, and you're seeing these candles produce, that's literally what I'm thinking. In real time, you would have still had confirmation on the TDI, because you're all the way down here at the bottom. So you're in the right place to begin with. What I'm trying to show you is just what does divergence look like. So you're going to see another example here. I'm going to pull up where it does show in real time. But I just want you to grasp the concept of what divergence is. Type 2, right? Type 2. Yeah. Let's bring in the TDI. So here, this would be the first leg here, right? Comes up, second leg. Notice how the first and second leg are pretty much the same, right? They're on the same level, basically. But if you look at the TDI, the first leg is here and the second leg is there. So there again, you have divergence. Now, one thing that you're going to notice a lot of is the TDI is really early, in the sense of what you see this happening here, like this is called the hook, right? So whenever you see this behavior here like this, and it's outside of this band, of the blue bottom band like that, or in this case, let's say the top like this is called the hook. And so what you'll find, or at least what I found, is that a lot of times this hook actually happens on the first leg, not the second. If you search TDI on TradingView, we use this one here, the one that's by Jay Donovan. And then you just want, once you add it, you just want to change these numbers to match. So these will be like the stock numbers or the regular numbers that come on it. And you want to change them to these numbers: 37, 32, 50, 68, 62. So notice the majority of the time you're going to notice this is that this hook action comes into play a lot of times on the first leg, not the second. So in a lot of ways, this is already like, it's almost like pre-predicting the future. So that's how that would work on those kind of examples, type 1s, type 2s. Type 3s, like this one, notice where the price action line is. It's right at the 50 on a type 3. But on type 3s, you'll see that it's bouncing off the 50. And by the way, most of the time you'll also see on type 1s, 2s, or whatnot that this will literally make a W, or this will literally make an M. It's very, very common. You see how this right here is just at the bottom here. This would be an example of a trade out of the edge, where the first leg is in Asian session, second leg is in the beginning of the London session, like I said before, that 445, 430 mark. And you can see the first leg is all the way down here. This is the second leg. It's already up here. But on the chart, it's the same, it's the same length basically. So it's like here, but on the TDI it's like that. You can see how divergence would play a huge part in what you're doing. So this one here, I'm just showing you because I want you to see this would not be a trade setup, but you can see how this literally is going straight down, and because this right here, this retracement did not have enough push to go back up because of the 50 EMA acting as resistance, kept price pushing down. You could see why it didn't come back up to the 50. If this candle would have stuck out to the 50, this right here would have stuck out to the 50 as well, and that would have been a type 3 trade. Price is coming out of the Asian range, hitting the bottom, hits one push up to the middle of the range, straight down. You're at the 50 here, straight down. US session, you have first leg here, comes up, second leg here on a railroad track. But again, look where you are. That's the first leg, that's the second leg, that's the first leg. The second leg is like all the way up here. So you have more divergence. Price action is in the right place. It's down here. Again, you notice how the hook here that happens on the first leg. This would be a type 2 trade out of the edge. Here you don't get actually a good confirmation from the TDI. The only thing that you do get is you do get a hook, but you don't get, price action doesn't quite make it to the bottom. And that's generally kind of like almost expected because it's a type 2 trade. The trade setups that come down here, like deep into this area here, into between the lines here, are going to be type 1 trades. Type 2 trades generally come up to only this top line here. Type 1s generally could dip down further, but they generally stay within this gray spot or this area here. But type 2 trades generally come down to maybe here. But this is another example of a type 2 trade. First leg in Asia, second leg at the beginning of the US session, before the 430. You can see you get a pullback here. You still get, the tiniest of hooks because it comes outside of the Bollinger Band here, and then back in. Here's a type 3 trade, bouncing off the 50, bouncing off the 50. So all the hook is, Hassan, is just when the green line, when this green line, which represents the actual price action, right, the candles, when this green line goes outside of the Bollinger Bands and then comes back in and gives you basically like that V shape, and it crosses the red line. Think of it in your mind like the crossover here of the green and red as like the same thing as like a 5 and 13 crossover on the actual chart. There are definitely strategies that you can build around the TDI. I try to keep trading as simple as possible and not complicated, because trading is already complicated as it is. Yeah, so you can see like how different the TDI almost responds to different pairs. So like this is Swiss JPY, and here is a type 1 pattern. See, this is a type 1 here, multi-session back to the 50, and you can see the first leg is like here, second leg is here. You have divergence here. You can see the second leg and the first leg are here. Alright, so you got divergence there on that one. You got a really deep hook too here on the first leg. And I mean, all these things, by the way, like you can build out, remember that list literally of 6 things that I talked about a couple minutes ago? You can add stuff like this, like did I get a first leg hook on the TDI or something, like all these things you can add. It just, it's really preferences upon you on how you want to use it, but you can customize it to whatever you like, and that's the point, because there is no cookie cutter way of trading. Like I can't, give you, I can't upload into your mind like my way of trading, right? I can only show you, but everybody, because we're all humans, we're all different. We have different, kind of slightly altered methods on how we understand and how we want to process our own trading. And so it comes down to kind of adapting and utilizing what is your specific way that makes sense to you. And that's why I said, like, you don't have to focus in on trading, all the type 1, 2, 3, 4s. You can just focus in on 1 or 2. It doesn't have to be all of them. Or you can focus more on finding the peak formation highs and lows, and then trying to trade off of that, or finding a pattern after that once you identify a peak high or low. So it's very customizable too, depending on who you are. The real trade here would be this, right? Now, would that be considered a type 2 or a type 1? So on this particular pattern, what is it that we want type 1s to do? If we take a look at, where it broke structure, so this is the high here of the Asian range, right? It went above at max, and this is including the wick, 16 pips. If you don't include the wick, it went up past about 7 pips. So it only went up 7 pips, and you can see the majority of it stayed within kind of like that range of riding on top of the top of the range there, right? So to me, this would be a type 2. For me to be a type 1, I would want this thing to be like up here somewhere. I want to see a break out of that structure to be clear and concisive, not to just kind of want to stick around here. I kind of don't. I don't know what I'm doing. I want this to be a clear break. So to me, this would be considered more of a type 2. And the TDI actually helps confirm it, because it's like right at the bottom here. You get the M at the bottom. Here's the type 3 here. pins to the 50 and the middle and the 200 EMA, and the same thing, you're pinning to the middle here. Now, if some of you may be thinking, well, why would this not be like, let's say, a type 2 buy? Maybe you're thinking that this is a pattern. The reason that I wouldn't be thinking that that's a pattern is because we're coming off of a peak formation high up here. So I wouldn't be looking for a buy to begin with. I'd be looking for sells. So my directional bias would automatically give me the idea of I'm looking for sells, not buys, so I would ignore this pattern going up. And besides, another thing as well is that you're like, this pattern here is happening like up here. Like, that doesn't make very much sense at all. You know what I mean? Like, the TDI is all the way up here, it's not even anywhere near the bottom. So there are things out there that you can see that you can use to help avoid those kind of mistakes. Right, so you get a type 3 in London, and then that leads you to a reversal, right, of a type 1 multi-session reversal in the New York session, basically. So you get a type 3 here, right, railroad track with a pullback, and then you can see this is hooking right at the 50, and then you literally get a multi-session W. Notice obviously this is all the way down here. Again, notice this is all the first leg, and it's already creating a W on the first leg. Second leg is right here, but on the TDI is all the way up here. Second leg gives you a railroad track, and you get a huge pullback as well on the next candle. So here's a type 2 setup. When you have the pattern, right, you have the pattern, whether it be an M or W, in this case it's a W. On the second leg of that W, if you get a railroad track, a star pattern, a quarter wood, any of those confirmation patterns on the second leg, right, you can enter the trade. Typically though, when you get a star pattern, railroad track and stuff like that, that candle that creates the railroad track or the star pattern are pretty big. So generally speaking, a lot of times you end up seeing that if you were to enter the trade right after that railroad track finishes, it would a lot of times push out a really bad risk to reward ratio. And so once that railroad track completes or star pattern completes and forms, the next candle, for the majority of the time, not 100% of the time, for the majority of the time, gives you a pullback. And sometimes that pullback could damn near be the whole candle, or at least half the candle. And so that gives you a way better entry than if you were to take, the railroad track at the full end. So if this right here is your pattern, and let's just say that this is your railroad track, right? The pullback that you see on the next candle, so this little pullback here, would be what you would use to enter your trade. Sometimes that pullback could be half of this candle here. Sometimes you'll see that it'll pull back all the way back down, and the more pullbacks, the better, because you'll get a better entry for one, and then your risk will be way smaller. So after the second leg produces a railroad track star pattern, if I notice that railroad track or star pattern is really big, like the candle itself is really big, and it kind of throws off my entire 2-to-1 risk reward ratio, then I'll wait for a pullback, and I'll mark it on the I'll mark out on the chart like where I would want. You don't have to wait for half the candle, Hassan. I think that just a pullback in general, that gives you a better entry. You know what I mean? So just a pullback in general, that gives you a better entry. As long as it gives you a good entry where you're not risking more than you should, you know. So on this second leg here, on the second leg right here, right? If you would have taken that trade here right after that second leg, so like right here, you would have had about a 17 pip stop loss, right? If you just wait for a pullback to happen, you had a pullback that you could have taken all the way down here, and now instead of a 17 pip stop loss, your stop loss is only 9 pips. So yeah, so think about the fact that now at 9 pips, now you're only getting 26 pips, but your risk to reward ratio is almost 3 to 1. You see what I mean? Compared to before, where you were at 17 pips, and on the same take profit, your risk would have only been 1.5 to 1. And so now you're having to search up higher, you know what I mean? To get more, to get your 2 to 1 basically. So it'd be more like this. Now you're searching for 35 to get a 2 to 1 because of your stop loss being 17 pips. And by the way, there's nothing wrong with having a 17 pip stop loss. I'm just saying that if you get a pullback, why not take the pullback? It's free pip. You know, it's free pips that it's saving you back, and it's allowing you to really start to build patience as well.
All right, guys. So I hope this video brought you some value, gave you some more knowledge that you can use in your everyday trading. Please do me a favor, guys. Like this video, guys. Subscribe to the channel. Let me know in the comments, guys. Do you use the TDI in your regular day trading? If you haven't used it, are you going to start incorporating it into your everyday trading now that you've watched this video? Let me know in the comments, guys. Until the next video, have a great rest of your week. Guys, if you need any more help or you like the content that we provide on this channel, come on over to the FXN MasterClass. It's available right now. What you get essentially is a lifetime membership, a full mentoring course, an advanced course. You get the Blue Summit videos, weekly Q&A sessions every Sunday, group session archives, which that by alone has about 100 hours of content, weekly analysis videos, midweek analysis videos, MT4 and MT5 indicators, a customized trading journal so you could actually journal your trades every day, and then a backtesting journal that you can use to backtest and collect all of your data. Not to mention a mentoring private chat, guys. So all the information is in the link in the description if you want to join now. We look forward to seeing you there, guys, and take care of yourselves.